Thanks for tuning into this conversation, this earnings conversation with Balrampur Chini. They came out the numbers wherein the sales and the EBITDA were largely in line. There was a miss on the PAT, but healthy contribution from both distillery and the sugar business. And I think the questions to Mr. Pramod Patwari, is the CFO of Balrampur Chini, would be around what is in store for the rest of the year after the start that they've had in Q1. Mr. Patwari, good having you. Thanks for taking the time out. How would you say the quarter shaped up for you? Was it in line with expectations, or do you believe a line item here or a line item there could have been better or worse?
Good afternoon, viewers. So we believe that the kind of performance which we were able to generate or give is morely in line with our expectation.
Mhm.
This is the direct outcome of the great efforts put in by our cane team with respect to the cane development activities. As a result of which, we have seen 16% increase in the cane output being made available to us. So last 2 years were extremely challenging for us in terms of lower cane availability, which resulted in lower profitability. So going forward, again, we have given a guidance of around 10% increase in cane availability further from this year. So all in all, looks good for us.
Let's start off with this availability and the output piece as well. I heard you say that after a challenging last 2 years, things look better. I also saw some additions of the con call wherein on top of whatever you have right now, you're adding a little bit, about 6 to 7% of the sugar capacity as well. And I believe that the extract would also be better, as I just heard you say in the first answer. Can you guide us towards the rest of the year on sugar?
Yeah, so the guidance is largely the same what we have said, that 10% increase in further cane crushing for the sugar to be beginning with from October 2023 onwards. So we are increasing the cane crushing capacity at one of our units by 2000 TCD. That's the best unit our in group in terms of cane cost, landed cane cost, and the recovery. So going by that rate, if there may be a further opportunity going forward, we may see for 2 or 3 other units also where we can see of increasing the cane level.
Realizations are higher by about 4%, if I'm not wrong. As you enter a busy second half, full of higher wedding dates, if I'm not wrong, as well as the festive season, would you expect these prices to sustain/improve?
So the realization for the quarter gone by was 36.85, around 3.5% higher than last year.
Okay.
But considering the amount of sugar which is available into the country, as of 31st of July, 108 lakh tons was there. And for the quota we have already seen for the month of August and September. If you consider a similar kind of quota for September, there will be another 47 to 48 lakh tons of requirement during these 2 months. So if you deduct them, still you will be left with around 61 lakh tons of sugar, which is good enough for 2.5 months, and we will be beginning the season maybe in third week of October. So there is no reason for the sugar prices to witness a runaway from this level.
Nor witness a fall. So I'm just trying to understand that
Nearest 50 paisa here and there, it's very difficult to predict.
Of course.
It should remain stable to firmness.
Got it. So I'm just trying to understand, and I'll come to your distillery through output as well as the offtake in a bit. But when I looked at the optical numbers, and please correct me if I'm wrong, but the distillery EBIT seemed to be lower. I'm trying to understand. First, I'm coming to the combined EBIT question for both sugar, distillery, as well as the other businesses put together. How do you think the quarter went by? Were there some one-offs which you hope to improve upon? And what could the rest of the year look like?
So there was no one-off as far as the company level performance is concerned. And I would recommend that sugar performance should always be seen at a company level and further on an annual basis and not on a quarterly basis. While evaluating the segment performance, it is a direct result of transfer pricing. If you increase or change your transfer pricing from, say, C to use route or B route, there will be a corresponding impact in the divisional profitability. So in this quarter also, heavy transfer prices has seen an change. It was 10,300 rupees a ton, which has gone to 10,900 rupees a ton. Juice proportion has increased substantially. As you know, the profitability from the juice is on a lower side as compared to B heavy. So naturally, the revenue will be captured here, but the profitability will be on the lower side.
Okay, so what then? Do you expect that this gross profit margin uptick of 800 basis points or the EBITDA margin uptick, if I'm not wrong, of 760 odd basis points, YOY that is I'm talking about, you think that these numbers are unsustainable? How would you expect the normalized numbers to be like?
So for that, I would request you to go 2 years back when we were having a certain optimum level of grain crushing, which is now the case for us. So we should be into that bracket. I would not like to give you an explanation that please extrapolate this number for the full year. That will be very difficult.
Right.
But as far as the revenue is concerned, it is more or less going to be a linear quarter going forwards. So you can really extrapolate the revenue what we have delivered in this quarter.
Got it. And I know you told me not to look at the segmental EBIT numbers quarter after quarter, but I'm still inclined to ask you this on the distillery side. Has the EBIT also been lower because of the change in the mix, and therefore could the new normal or the average for FY24 on the distillery EBIT be different and lower than what it was for FY23?
FY23, there was no juice component. So surely the mix has changed because of the introduction of the juice-based ethanol. So the mix will definitely be changing. As far as the cane crushing volume is, because the distillery volumes will be a direct function of cane crushing. So we are expecting around 11% of cane we will crush into juice route, around 25-26% into C heavy, and the rest will go into B heavy. So earlier the proportion of B heavy was on a higher side. That is going to change from FY24 onwards.
I get your point. So, Mr. Patwari, because there is a lot of moving parts now and it becomes difficult for people to maybe analyze it very, very easily upon the reportage of the numbers, I would love to understand from you, how do you see the next, not just the 3 quarters, but the next 1, 2 or 3 years, as a large part, I presume, of your capacity expansions may be behind you, but efficiencies coming into play and mix changing both on the ethanol side, because you're getting grain also into the mix in a big way, as well as on the sugar side. So how do you expect the next, say, not just the 3 quarters, but the next 7 quarters to be like for your company, as well as maybe for the industry?
Okay. So as far as our company is concerned, we are right now focusing on the cane development activities. And the success of that we have already witnessed in the season gone by 22-23. On 23-24, we have given you a further guidance of 10%. There is still a possibility of improving further from that level also. So if that happens, there will be a corresponding benefit which will flow across all the segments into the company in terms of raw material or feedstock availability. So our focus going forward is to produce only that much of sugar which we can sell into the domestic market. And for that to achieve, we would be required to divert more and more towards B heavy as well as juice.
Okay. Having said that, I would still probe you a little bit more, Mr. Patwari, if you allow me. If I look at what's happened over the last, let's say, 4 or 5 years, I look at the last trailing 12-month earnings as well, taking into account the Q1 numbers, and you're a premier sugar company or a premier sugar stroke distillery company, revenues circa 4,500 to 5,000, and please correct me if I'm wrong here. Operating profit hovering between that 600 to 720, 730 mark. Is there a chance that numbers could look different, let's say 3 years out, 2 years out, and what would cause that?
I have already given you some guidance with respect to revenue for the FY24. And again, at the cost of repetition, I would say that since the cane is in the backyard, which was impacting very badly on the overall profitability of the company, the profitability margins will improve from here on.
The problem,
as we will be having the raw material availability with us. As far as distillery performance is concerned, gone are those days when the molasses prices were very low. If you recall 3-4 years back, C heavy molasses prices was zero, almost zero. And in that particular year, we were having 65 to 70% as the profitability margin in distillery. Now with that prices of C heavy again coming back to 600, 700 rupees a quintal, and B heavy, we started with 7,000 rupees a ton, now 11,000 rupees a ton. Juice is taking a significant proportion in the overall distillery mix. Profitability on the juice is lower. So that kind of number will not be possible for us to deliver as far as the distillery section is concerned.
Sure. Okay. Well, I missed your comment the first time, which is why I had to ask you to repeat yourself when I was hoping for being able to understand what would it mean in terms of numbers, but I understand it's a moving target. One last question, Mr. Patwari. What has also happened subsequently, and again, the below the operating line numbers, there has been an uptick both on the finance costs, on the depreciation charges as well, which might be impacting the bottom line, even though it may not be an exact cash item in certain cases as the depreciation is. How would you believe these numbers shape up over the course of the rest of the year?
Both are a direct result of the capacity expansion which we have undertaken in last 1.5 year. So as far as the depreciation number goes, looks like this will be in the region of around 160 odd crores on an annual basis going forward. For interest, with the gradual repayment of loan, which will happen going forward, interest may come down. Maybe FY24 will be higher than FY23. That is for sure. That's it. And we have always maintained a balance between the dividend payouts as well as the capex also. So that has also resulted into the slightly higher borrowing. And these borrowings, long-term borrowings, are in the interest rate of 4.5%. So all this loan will leave its life.
Got it. My final question, as you move ahead and as the one company with arguably the largest capacities of both sugar and ethanol individually as well as combined, how would you expect the mix to be? If I'm not wrong, on the call, you said that you expect the distillery mix to move up to 35% from 30% earlier. Would that be the new normal of sorts, or would that change as the years go by as well, Mr. Patwari?
So for next 1.5 or 2 years, this is going to be the range. Distillery proportion could be around 35%. Thereafter, we will have to see what kind of cane development cane is made available to us in terms of our command area. We'll have to take a distillery expansion call at that point in time. As far as the grain capacities are concerned, we have always considered this as a pillar to be operating only in the off season. But as going forward, our cane availability will increase. Our dependence on this FCI rice, or for that matter, open market rice, will gradually come down.
Well, that's good to know. Great, Mr. Patwari. Wishing you all the best for the quarters ahead. Thanks for taking the time out and speaking to us today.
Thank you. Thank you.
And viewers, thanks for tuning in.